Good morning, everybody, and welcome to our post-autumn statement event. It feels like we've had quite a lot of budgets or budget-like events this year. I hope this is at least the last of the calendar year. As ever, we've been looking at the details of the autumn statement overnight, and we've got quite a lot to tell you this morning. I'll start off with some opening remarks. We will then hear from Carl Emerson, who will talk about the public finances, Ben Zaranka, who will talk about public spending, Stuart Adam, who will talk about tax, and Xiaowei Zhu, who will look at living standards and the welfare changes. Any questions that you have, please put into the Slido link, which everyone has access to, and great if you include your name so we know who you are when you put your question in. All of the slides and my opening remarks are up on the IFS website, hopefully round about now. Certainly my opening remarks will be there. I'm going to run through those quite quickly now rather than read them all out. You can read the whole lot if you want. I think the key point about yesterday's event from the public finance point of view is that Jeremy Hunt was actually, while obviously more fiscally conservative and responsible than his immediate predecessor, Kwasi Kwarteng, actually did relatively little to offset some very big increases in borrowing. He set himself much the loosest set of fiscal rules that any of his predecessors have had, certainly since 2010. He decided it's fine to borrow to cover current spending, and he's meeting his fiscal rules in 5 years' time by a hair's breadth. So this was, oddly enough, and despite a lot of the coverage, not a particularly fiscally conservative statement. Mr. Hunt really did, I think, the minimum he felt he could get away with, or the minimum he felt he needed to do in order to regain some fiscal credibility. And nearly all of the tightening that he's doing is coming after the next election. There's not very much at all happening over the next couple of years. Indeed, spending is rising over the next couple of years. Now, given the precarious state of the economy and uncertainty surrounding the forecast, there is some good reason for that. He's clearly hoping for good news coming along later on, so the spending cuts that he's effectively penciled in post-election aren't needed. But remember that uncertainty runs in both directions. Things could turn out worse than predicted. So he's erring on the side of caution in terms of protecting spending in the economy in the short run, rather than erring on the side of prioritizing shoring up the public finances. It's worth saying that the OBR, whilst not cheerful, is a lot more cheerful than the Bank of England. The Bank of England's forecasts are much gloomier than the OBR forecast. So the Chancellor must at least be grateful that he's responding to the OBR and not to the bank. If the bank is right, then even more pain is going to be required. It's a strange quirk of the current system that monetary policy and fiscal policy are made off the back of two quite different but official forecasts. Now, there's a curiosity here. Borrowing is going to be high into the foreseeable future. Tax is going to be very high indeed. Indeed, our tax burden is going to settle at its highest level in history relative to national income. So lots and lots of borrowing and lots of tax revenues, you might think, well, lots and lots of spending. That kind of makes sense, doesn't it? But actually, those post-election spending plans are really pretty austere. That's a pretty nasty place to be. High borrowing, high debt, high tax, and public spending under strain. Now, how are all of those things consistent with one another? Well, part of the answer lies in the fact that we just got a whole lot poorer. That's the central fact that underlies most of what we heard yesterday. Part of the answer lies in the extraordinary scale of expected spending on debt interest. That looks like doubling relative to forecasts, hitting £100 billion a year by the end of the forecast period. So we're going to be spending more on debt interest than we're on any individual public service bar the NHS. So interest rates are up. We've been borrowing an awful lot. A lot of that's held by the Bank of England, where we have to pay the base rate on that debt, borrowing more over the next few years. All of that is coming very much home to roost. We are discovering rather painfully that borrowing really is not a free lunch. That increase in debt interest, higher spending on health and on benefits, particular pensioner benefits, entirely explains the growth and the size of the state in the period from 2019 into the later years of this decade. With defence spending cuts off the table, an ageing population, and apparently pressures everywhere else you look, I have to say my guess is we have started a new era, in this case a new era of higher taxation and higher spending as a fraction of national income, and hence a bigger state. It's quite remarkable, as you'll see in some of the charts later on. It is a sharp change. One hesitates to make forecasts about sharp changes being persistent, but I would be most surprised if the tax burden gets back down to its long-term pre-COVID average at any time in the next several decades, quite honestly. Higher taxes, a bigger state, look to me to be here to stay unless something quite radical changes. So on public spending, over the next couple of years, the numbers don't look too bad. Despite higher inflation, real public service spending looks like it's due to grow only really marginally less quickly than was planned last September. And remember, last September's spending review looked pretty generous relative to where we've been over the last decade. Now, in part, that's because the Chancellor's found more money for health. And remember, there was quite a lot more money announced last year for health, more money for schools, more money for local government to particularly pay for social care. So there's more money there for those bits of public services, no more for the rest. It's also worth saying the figures in terms of growth are flattered by underspends in the base year, which makes the increases look bigger. And also so some, I don't know if quirks is quite the right word, but the way the GDP deflator is defined, and that is how we define what is a real increase in spending, makes a big difference here. The GDP deflator, the measure of economy-wide inflation, is much lower than CPI inflation. All of that does mean that the government, despite those numbers not looking too bad in those kinds of terms, the government's still not going to be able to fund pay rises that anywhere near match inflation in the public sector from within the planned spending totals, unless there's a big loss of jobs. Public pay setting, in my view, will remain one of the biggest challenges facing this government over the rest of this year and into the rest of the period up to the next election. Public pay, don't forget, has done even worse than private sector pay over the last decade, and is doing even worse than private sector pay at the moment. The fact that nurses, teachers and so on are balloting for strike action is an indication of the scale of that problem. Beyond the next 2 years, all the spending numbers, it's worth saying, should be taken with a very large pinch of salt. After all, they are spending penciled in for after the next election. If they are kept to, they'll mean cuts, relatively modest ones, but cuts nonetheless to most public services. I have to say it's unlikely that they will actually be kept to. I'd be willing to wager quite a considerable sum that spending will turn out higher than planned. It literally always does. Of course, if it does and the forecasts are right, that will imply either more taxes or more borrowing alongside. In my opening remarks, I want to make two specific points about funding, about spending. The first is, it's awful, isn't it, that the social care reforms will not now be implemented next year as planned. There's another 2-year delay. I really do fear that yet another delay, where are we, a decade after the Dilnot report, another 2-year delay may well amount to a death knell to these vital changes. Government really should not be making and then reneging on promises like this, which matter so much to vulnerable people. Second is a question: what on earth is happening to incapacity and disability benefits? Since March, the OBR has revised upwards its estimates of spending on these benefits by a staggering £7.5 billion a year, and estimates the number of recipients will rise by more than 1 million over the next couple of years. That is an astonishing and really quite worrying trend, if true, relates to this big issue, of course, of people dropping out of the labour market. At the same time, we have a delay until 2028 in moving existing claimants of out-of-work health-related benefits onto universal credit. With no explanation given, universal credit is supposed to be fully rolled out well before then. I have to say this looks horribly like an effort to push a relatively small increase in spending to beyond the forecast horizon, and in doing so delaying the full rollout of the new system. All of this, very odd, very concerning, more for us to do to dig into what's going on there, but an issue to worry about. On living standards, of course, the most striking figures in the OBR report are those pertaining to the 7% fall that they're forecasting in real household disposable income per person over the next couple of years, the biggest fall in living memory, possibly ever, in income growth over a 2-year period. This is going to hit everyone. Of course, it's a manifestation of the fact that we are just poorer, significantly poorer as a result, not least of what's been happening to energy prices. Broadly speaking, I think it's those on middling sorts of incomes who will feel the biggest hit. They're not going to benefit from the targeted support to those on means-tested benefits. Their wages are falling in real terms. Their taxes are rising. Their housing costs are probably rising. Middle England, I think, is set for quite a shock. And of course, all of this follows a painful decade. Median real wages are set to remain at much the same level as they were at the start of the 2010s. Earnings and incomes have barely risen. On some measures, it looks like we'll be an astonishing 30% worse off than we might have expected to have been had pre-financial crisis trends continued. It's worth saying significant support to benefit recipients on top of capping average energy bills at £3,000 will provide a better and more targeted approach to high energy prices than proposed by Liz Truss. And put all of the tax and welfare changes together, this was a progressive fiscal statement. Tax rises for the rich, increased targeting on the poor. It's just that virtually all of us can expect to end up poorer. Finally, on tax, it remains the case that the big tax changes coming in over the next few years are those that had already been announced. Corporation tax revenues will hit record levels as the rate rises to 25%. Now, I never expected I'd be saying that in the early 2020s. Freezes to income tax allowances and thresholds constitute a very, very big tax increase indeed. The measures announced yesterday were modest by comparison. In the longer term, the biggest is the freezing of the point at which employers start to pay national insurance contributions, though more immediately the energy profits levy is due to raise more. Reducing the point at which the additional 45% rate of income tax kicks in, a big statement from the point of view of the tone, actually raises less than £1 billion a year, as does the reduction in dividend allowance. The cut to the capital gains tax allowances raises less than £500 million. All of those changes will largely hit the better off, but they are hardly game changers. What is a game changer is that there is a huge structural change to income tax. When the additional rate was introduced in 2010, only around 200,000 people paid it. Now, anyone earning over £100,000 pays 60% tax. Anyone earning over 125,140 pays 45% tax. That's 4% of adults, about 2 million people by the middle of this decade, paying at 60 or 45%. That's more than we're paying the higher 40% rate back in 1990. Meanwhile, there'll probably be 8 million people paying at that 40% rate. This is it's a fundamental, it's a complete change to our income tax system and a big increase in the marginal rate of tax faced by millions. Beyond that, of course, there were lots of tax changes. There were tax changes to capital, there was capital gains tax, there was dividends tax, there was business rates, there was a vehicle excise duty, there was stamp duty. What all of those changes have in common is I saw no sense of direction, no sense of strategy, no sense of how any of these fit into a long-term view of where the tax system is going to go. We've had a huge extensive review of business rates. They're being cut. There's a supposedly extension to a temporary cut for retail and hospitality. That's going to be really hard to undo. Where are we going with business rates? How are we going to tax electric vehicles in the long run? Increasing vehicle excise duty on them is a tiny change, doesn't tell us anything about how we're going to replace fuel duty. Are we actually going to properly reform capital gains tax rather than fiddling around with the allowance, and so on? This really matters as taxes rise in general. So to conclude, Chancellor is hemmed in by rising interest rates and dreadful growth prospects. In being hemmed in, he's decided largely to allow borrowing to rise and to put off the tough decisions for another couple of years. He may well hope that things will look better by then, or perhaps that it will be somebody else's problem. What we're really doing, of course, is reaping the costs of long-term failure to grow the economy, the effects of an aging population, and high levels of past borrowing. After years of stagnation, household incomes are set to fall and then recover only gradually, while taxes rise and public services continue to struggle. What a combination. The truth is, of course, we just got a lot poorer. We're in for a long, hard, unpleasant journey, a journey that's been made more arduous than it might have been by a series of economic own goals. Mr. Hunt appears to have recognised this after years of cakeism. His colleagues and the opposition, and we the voters, are going to need to take that fact on board too. I will now hand over to Carl.
Thank you very much, Paul. I will share my screen, and I'm afraid I can't turn my video on at the moment, but hopefully people can see the slides. So I'm going to talk about how the outlook for the public finance has changed and what Jeremy Hunt decided to do about it. And I'm going to highlight some of the key risks around the forecasts going forwards. And as Paul said, the starting point, and as I guess was widely expected, is that the OBR revised down its forecast for economic growth over the next few years. So these are the forecasts that were produced in March for steady, if not unspectacular, growth. And these are the forecasts that were presented yesterday for a recession and then stronger growth resuming, but still the economy running well below what was expected in March, a downgrade of about 4% in the middle of 2025. Things could be worse than that. There's clearly uncertainty about the path of the economy. And if you take the Bank of England's forecast produced just a couple of weeks ago, and you take their forecast produced on the idea that interest rates will follow market expectations, well, if that was the case, the downgrade to the OBR forecast would be more than twice what we saw yesterday. And even if we take the Bank of England's forecast that's predicated on the idea that interest rates remain constant rather than rising, you'd still see a bigger downgrade. So uncertainty around the OBR's forecast, and certainly we and Jeremy Hunt must hope that they are right and not the Bank of England, or even better, that things turn out better than what the OBR expects. Is it the case that the OBR is particularly optimistic? Well, actually, if you compare them to a wider set of forecasters, it's not clear it is the case. This shows the OBR's forecast alongside the Bank of England's, the IMF's, and the other independent forecasts that are surveyed by the Treasury. And it looks like the OBR, at least at the moment, is around the middle of the pack. So there's uncertainty on both sides. So what did this do to the outlook for government borrowing over the next few years? Well, these are the forecasts for borrowing that were produced in March, a deficit of over £120 billion in the last financial year, but falling down to kind of just over £30 billion by 26-27. But there's been lots of changes since. There's been changes to the economy, like I just showed you. The outlook for the economy is weaker. That adds to borrowing going forwards. So this shows how big those underlying changes since March have been. And actually a big driver of that has been an increase in the outlook for debt interest spending. That more than explains the increase in underlying change coming from underlying changes this year, and explains a very big chunk in future years. So let's look at the outlook for debt interest spending in a bit more detail. This chart is showing you how much the government's been spending on debt interest as a share of national income in each year going back. And if we take the March forecast, at the time it looked like there'd be a big spike in spending this year caused by higher inflation. But then if we look through that spike, spending would return back down to the low levels that we've been enjoying since 2000. So no evidence of a long-run problem from debt interest there. Unfortunately, that situation seems to have changed. The blue line here shows the OBR's forecast from yesterday. That spike in debt interest spending is now expected to be much bigger, a record level, debt interest spending at a level we've not seen for over 70 years, although I should add it wasn't uncommon before that. But more importantly, when you look through that peak, you see that debt interest spending falls, but it stabilizes at a level that's still pretty high by recent years. It's high by the standards that we've seen since 2000. So essentially a combination of all of that debt we've accumulated since 2008 and the fact that the outlook for interest rates is now higher than we've been used to over the last decade leaves debt interest spending higher. Now, here's an area where I think there's actually some cause for optimism in the OBR's forecast. While they've revised up their outlook for debt interest spending, I think it's possible that debt interest spending won't rise as sharply as they expect. So these are the forecasts that were produced by the OBR in March for debt interest spending. And these are the forecasts that they presented us with yesterday. So you can see in 26-27, they were projecting that debt interest spending will now be £95 billion, double the 47 they were predicting back in March. Now, these forecasts for debt interest spending that the OBR produce take market expectations of what interest rates will be. That's one approach. An alternative might be to say, what are independent forecasters saying about where they think interest rates are going? And let's use that when we're trying to project debt interest spending. So if we take the average of independent forecasters' expectations, it is the case they think that interest rates will be a lot higher than what was expected by the OBR back in March, but it's actually lower than current market expectations. So while there'd still be a big increase in debt interest spending relative to March, it wouldn't be as big as the OBR expects. So in the coming financial year, debt interest spending would end up about £9 billion lower than the OBR expectation, still £50 billion more than they thought back in March. But in 26-27, the increase would be reduced by £17 billion. So this is an area of the forecast where we must very much hope that things could turn out better than the OBR expects. As Paul said, there was also another change in the forecast that looked quite puzzling and concerning, and that relates to one part of the Working Age Benefits Bill. The OBR revised up by £7.5 billion how much it expects to spend on disability and other health-related benefits in 26-27, and that's over and above the upwards revision it made because of higher inflation. So this is coming from a huge increase in the numbers that the OBR expects to be receiving these benefits. Previously expected 8.2 million people to be receiving these benefits in 26-27. That was just in March. It now expects 9.3 million. So a 1.1 million increase in its forecast over just a 8-month period. Now, there's relatively limited information provided by the OBR about this. We're going to follow up and try and find out if there's more on what's going on. But our reading of the evidence suggests that it's driven mostly by the benefits which are available to those who are out of work because of having a work-limiting health issue. So it's not the benefits, we think, that are there for people who are in or out of work who are getting support to help them with the extra costs of that disability. We think it's the out-of-work benefits bill, the incapacity benefits, that is driving it. I think it's also worth noting that the autumn statement also said that for people who are on these out-of-work incapacity benefits who haven't yet moved across to universal credit, they're going to delay moving them across until 2028. That's despite the fact just last April, the government committed to having them all moved over by the end of 2024. Now, we don't know, but we wonder if there's some connection with the increase in caseloads. But there could be another explanation. It could be that by pushing it to 2028, what the government's trying to do is just push the costs of having to do this change until after the end of the forecast horizon. And we note that the government is also trying to merge pension credit with pensioner housing benefit. And the autumn statement yesterday also announced that that is also going to be delayed until 2028, which will also have the impact of reducing public spending throughout the forecast horizon. Let's go back to the outlook for borrowing. The other thing that happened between March and before yesterday's autumn statement is we had a whole load of policy changes. So we had the energy price guarantee announced by Liz Truss. We also had things like the abolition of the health and social care levy. So these also acted to increase the outlook for borrowing. So what that line shows you on this chart now is what the outlook for borrowing would have been had Jeremy Hunt stood up yesterday and said, actually, I'm not going to implement any new measures. I'm just going to let borrowing go along this path. I'm going to allow the underlying changes and the policy measures announced since March to push borrowing up. And you can see that would be quite a substantial increase in borrowing. The difference between the March forecast and that pre-autumn statement forecast in the current financial year is about £80 billion. And in the last year, in 26-27, it's running at about £90 billion. So let's look at that increase in borrowing. That's shown by these dots on this chart. This is the increase that would have happened had Jeremy Hunt not done anything yesterday. And we can answer the question, how much has he decided to try and offset that increase in borrowing with new spending cuts or new tax rises? And that's shown by these bars. And the answer for the current Parliament is he's really not trying to do very much to offset that increase in borrowing. There could be good economic reasons for that, but it does mean we'll be borrowing a lot more in the next couple of financial years. Beyond that, there is a fiscal consolidation plan that starts to get into action. But even in 26-27, you can see that the new tax rises and spending cuts are offsetting less than half of the increase in borrowing that we've seen since March. We can also break those measures down into whether they are permanent spending cuts, whether they're temporary tax rises, the energy and the windfall tax on energy companies, or whether they are permanent tax rises. And on our calculations, the new tax rises we heard about yesterday are explaining about 40% of the planned fiscal tightening in 27-28. So 40% from tax rises, 60% from spending cuts. And we can compare that to previous consolidations. George Osborne, when he was Chancellor, set out to try and achieve a fiscal consolidation that was 80% spending cuts and 20% tax rises. So Jeremy Hunt's plan is more tax heavy, less spending heavy than that. But when Ken Clarke in 1993 was trying to fix the public finances, our calculations suggest that he went for an approach that was roughly 50-50 tax rises and spending cuts. So one that was more tax heavy than what Jeremy Hunt is now trying to do. So where does this leave taxes as a share of national income in the United Kingdom? Well, if we go back to March, these were the forecasts for tax as a share of GDP over time. You can see that they were set to rise and reach levels that we hadn't actually sustained since the 1950s. After the mini budget, Chancellor Kwasi Kwarteng was still seeing tax as a share of national income at pretty high levels by UK standards, but he had them on a downwards path because of that big package of tax cuts that he announced in his mini budget. Jeremy Hunt is much more than the reverse to that. The new tax rises means that the taxes as a share of national income are set to grow well above what was expected even in March and be well above anything that the UK economy has sustained in its history. So taxes as a share of national income, high by UK historical standards. It's worth saying that there are other successful economies in Western Europe and Scandinavia that sustain higher tax burdens than this. So government borrowing up in the near term, where does this leave the path for government debt? Well, back in March, when Rishi Sunak was Chancellor, he wanted to have debt falling as a share of GDP 3 years out. And he set out some forecasts that showed that this was going to be achieved, but only just. He didn't really have debt on a decisively falling path. It was gradually falling. There was a margin of error, some headroom he had of about £28 billion. That sounds like a huge sum of money, but in the context of trying to forecast the change in debt 3 years out, it's really not a big margin. Where are we now? Well, the extra borrowing over the next couple of years pushes debt up. And at the end of the forecast horizon, when Jeremy Hunt is now trying to make sure debt is falling, he's trying to get it falling in 5 years' time, not in 3 years' time, he's just about got it falling. Believe me, that line is coming down, even though you can barely see it. He has a headroom of £9 billion. That's absolutely tiny. It suggests that on current policy settings, there's roughly a 50-50 chance on whether debt will actually be falling in 27-28. And there are some big risks around this forecast. One set of risks relate to the revenue side. The current baseline for forecasts assume that each April, the rate of fuel duties will go up in line with the RPI. And that hasn't happened since 2011. Moreover, they assume that the 5p cut to fuel duty that's currently in place will be allowed to expire in April. So if that all goes ahead, that implies that fuel duties would go up by a whopping 23% in April. I predict that's not going to happen. If we freeze rates again, it will cost about £6 billion in 23-24. As Stuart will talk about, we've also decided to freeze many allowances in the tax system, and in particular, the personal allowance and income tax are set to be frozen for 6 years. In the last year of the forecast horizon, that raises about £1.3 billion. And I think there's a genuine question about whether that's credible. In my lifetime, the maximum freeze that we have managed is 2 years. So it'll be interesting to see whether a 6-year freeze really does happen. So to conclude, there's been a big deterioration in the outlook for the public finances since March due to a much weaker economic outlook. And much of that deterioration is actually explained by higher interest rates pushing up debt interest spending. And actually that increase in debt interest spending could be smaller than what the OBR expects. There is some room for optimism there, I think. The measures outlined by Jeremy Hunt in the autumn statement only counteract a small share of that deterioration in the public finances. And of the measures he set out, we reckon that tax rises are explaining about 40% of the tightening, spending cuts about 60%. There are risks to this. Some of the policy risks are, will taxes as a share of national income really be sustained at 37% of national income? There's also risks on the spending side. Yesterday, Jeremy Hunt trimmed his planned level of spending in 27-28 by £30 billion. That raises the question of whether the spending plans can really be kept to. And that's something that Ben Zaranko will now address in his presentation. Thank you.
Thanks, Carl. Good morning, everybody. I'll now run quickly through the impact of yesterday's announcements on public services. I want to focus first on the short term. I'll turn to the medium-term picture after that. There was really two budgets yesterday, one for the next few years and one for after the next election. So the starting point for the short-term outlook is that at last year's spending review held last October, the government set out 3 years of detailed department by department funding settlements. Those run for the 3 years up until 2024-25. Now they're fixed in cash terms. That means they don't automatically adjust if inflation or pay awards differ from what was initially assumed. The cash budget has to take that into account. Now, despite what we might have expected and given what's happening to headline consumer inflation, the overall generosity of those plans hasn't actually shifted much on paper. So just to illustrate that, if we look on the left-hand side here, I'm going to show you average real terms growth over the 5-year parliament. The green bar is what was planned for the last year's spending review. The blue bar is what is now implied based on yesterday's plans for overall day-to-day departmental spending. So stripping out investment, this is for spending on things like staff and day-to-day running costs. You can see very similar. And if we just look at the 3 years covered by the spending review period, again, very, very similar, if anything, a slightly faster growth rate. Now, that's puzzling given what we keep hearing about, including our own publications talking about inflation eating away at the generosity of departmental budgets. So what's going on? Well, there's a few things. First of all, the measure of inflation that we typically use for such calculations is called the GDP deflator. It's a measure of economy-wide domestic inflation. That's going to be higher in the short term, but not that much higher, and actually is forecast by the OBR to be lower in the medium term. So let me show you that. Green bars here show you the annual forecast inflation as per this measure last October. Yellow bars show you March, and the blue bars show you as of yesterday. So you can see the blue bars there, GDP deflator inflation spiking up to almost 5% this year. Now that's well below CPI, which is running at more like double that rate, and about 3% next year. Then you can see on the right-hand side, it falling back and actually being lower than what was previously forecast. And lower inflation means a given level of cash increases equates to a faster real terms growth rate. So in the short term, why is it so perhaps unexpectedly low? Well, it's being held down by the fact that import prices are growing much faster than export prices. Much of the inflation we're facing in the UK is driven by rising costs of imported food and imported energy and imported fuel. Because the GDP deflator measures domestic inflation, those don't feature. And there's also some impacts from unwinding lockdown effects on public services. Then in the medium term, weak consumer price inflation and consumer demand, combined with slower growth in the government part of consumption, holds that down. And that's why you've got this very low, below 1% rate of inflation in the later years of the forecast. So those lower rates of inflation flatter the real terms growth in the government spending plans. There are very good reasons to think that that measure of inflation, while perhaps the best one we have, isn't going to perfectly capture cost pressures on public services. There are particular challenges around pay awards. So the GDP deflator next year is expected to be about 3%, CPI about 5.5%. So if government departments offer an inflation matching pay award to their workers, that's clearly going to exceed the cost pressures that would be suggested if you just looked at the GDP deflator. And pay is going to be a very difficult policy area. It's extremely hard to see how you could have pay awards matching inflation, or indeed real terms pay rises for public sector workers over the next few years, without either cutting back on headcount or cutting back severely on some other area that will determine service quality. There was also some extra money yesterday. There was extra money for the NHS and for schools, a couple of billion each. And there was quite a bit of extra money for local government. And it's not very often we get to say this at these post-budget events, but local government was actually a particular winner, with more money from grants, being allowed to raise more in council tax, some compensation for business rates indexation change, and also reallocating some funding that was previously earmarked to implement the social care funding reforms, which, as Paul said, been delayed and might eventually get canned entirely, but that frees up money that can be spent on other things. So councils, particularly those with social care responsibilities, did fairly well out of yesterday's announcements. Other less fortunate budgets will instead be left facing a squeeze from inflation. The OBR estimate that squeeze might be between 5 and 15 billion over the spending review period, depending on how you measure it. That's clearly going to be very difficult for other budgets to absorb. There's also a final thing, which is that big underspends last year by departments lower the starting point, they lower the baseline. So increases relative to a lower baseline, those percentages look larger. So altogether, the overall generosity on paper hasn't changed much. Pay decisions look very difficult. There might be good reasons to think that the actual cost pressures are a bit greater than is suggested by the official figures. And if you're not schools, local government, or the NHS, you're being asked to squeeze your budget, and that's going to be painful. Then after 2025, there were some cuts to the government's plans for spending. So that you can see that here. You can see on the left-hand side, the extra money there for the NHS and social care and schools, but you can see on the right-hand side, reductions in planned spending. Now you can see the yellow bar there is the cut in what was penciled in for aid spending. The government originally was planning for aid to return to 0.7% of GDP. It will now be held at 0.5% of GDP. One quirk yesterday was while the Chancellor dropped and changed his headline fiscal rules, he left his original fiscal rules as the thing that will determine when aid goes back to 0.7% of national income. We still have to be running a current budget surplus for that to happen, which is not expected to happen over the entire forecast period. So how did they manage that? Well, they actually just basically tweaked the spending assumption that is applied beyond 2025. So previously, average day-to-day departmental funding was set to grow by more than 3% per year above inflation. That's now 1%. But a 1% increase on average, when combined with increases for some areas, is probably going to mean cuts for other less fortunate, what we might call unprotected budgets. So the OBR provided some useful analysis of this yesterday. They showed that if the overall day-to-day budget rises by 1% per year, you give the NHS 3.1%, which is what it was intended to get over the this 5-year parliament. You keep per pupil funding in schools flat, but because pupil numbers are set to fall, it means you could reduce overall school spending by a bit. You hold defence and aid spending constant as a fraction of national income. You're left, look at that red bar, cutting everything else by about 0.7% per year if you want to stay within those plans. So that's one reasonable guess or estimate of what those plans might imply for public services. Now, that's not the only one. We can consider alternative scenarios, in particular scenarios where the government provides extra funding. So let's consider a different set of assumptions. Maybe the NHS grows at more like its long run average rate, so more like 3.8% rather than 3.1. Perhaps that would better allow the NHS to deal with the substantial pandemic pressures, post-pandemic pressures it's facing, the number of COVID patients it has, the scale of waiting lists, for example, and to put in place a long-term workforce plan and maybe offer some slightly more generous pay awards. Let's assume that overall schools funding remains flat. So rather than falling in line with pupil numbers, you've still got to have the same number of classrooms and schools in the short term. So it might be difficult to cut spending. Defence, let's instead assume that it rises towards 2.5% of GDP. That's more in line with what Boris Johnson and Liz Truss had committed to, and actually more in line with what Jeremy Hunt promised when he was running to be Prime Minister a few short years ago. And if we hold aid constant as a fraction of national income and freeze everything else, avoid making cuts, well, you'd have to find about £17 billion extra by the end of the period. If you didn't find 17 billion extra and you wanted to do all those things, you'd have to cut those unprotected budgets by about 3% per year. Now, £17 billion in the scale of some of the huge numbers Carl was talking about isn't enormous. It's well within the realms of possibility. It's also roughly what recent experience might suggest is likely. So if we look at the last 4 spending reviews, and we look at these provisional spending totals that were penciled in by various chancellors, and then we look at what actually happened when they came to holding a spending review, allocating it between departments, making those actual tough decisions about where the cuts are going to fall, well, they always ended up getting topped up. So you can see top up varies in scale, but on average, the final year of these provisional plans gets topped up by about 3.7%. If history repeats itself, that will be about £18 billion extra by the end of the period, very similar to the 17 billion I showed you on the previous slide. So you might think of that as a sort of reasonable estimate of what might get added to spending plans. And that combined with, for example, freezing fuel duty would take the Chancellor further away from delivering on his fiscal objectives. Now, turning to capital or investment spending, again, it was a sort of a game of two halves. In the short term, the Chancellor stuck to his existing plans, but then after 2025, he penciled in a cash terms freeze. Now, a cash terms freeze, when inflation is positive and rising, and when the economy is growing, means that investment will fall in real terms and fall as a fraction of national income. So showing here how public sector investment has evolved over time and what it looks like over the forecast period, you can see that it's set to be still above where it's been for most of the past 40 years, still above 2% of GDP, though you can see lower than it would have been under pre-autumn statement plans, about 15 billion lower in the final year. The challenge is that the Chancellor has said his 3 priorities will be energy, innovation and infrastructure. But if you protect those budgets, if you protect, for example, investments in energy infrastructure and research funding and transport and digital, because those things are all important, well, if overall spending is falling, does that mean a squeeze on other things? Does that mean, for example, a squeeze on the capital budget for the NHS or the prison system or the further education system? There might still be difficult choices to be made here, even though overall investment spending will remain at what is a fairly high level, at least by UK standards. So to sum up, there's some extra money in the short term for schools, NHS and local governments. That undoubtedly will be welcome. Other less fortunate public services will have to absorb cost pressures from higher inflation. There will still be some very difficult choices about public sector pay. Sticking to those cash spending plans for the next few years is very difficult to see how that's consistent with inflation matching pay awards. There could be another round of potential real terms pay cuts for public sector workers, and potentially a round of strikes in response. It's also worth saying that there might be more money available for things like the NHS, but there's still a potential disconnect between the funding available and what they're being asked to deliver. The extra cash for the NHS, for example, came with a list of additional asks in terms of what it's going to do about ambulance waiting times and urgent care and things like that. And so there's a danger here, particularly with the substantial cost pressures departments are facing, is the funding available isn't enough still to deliver on the government's public service objectives. And after 2025, the plans look, in our judgment, implausibly tight. The hope is clearly that they'll never have to be implemented, or at least someone else will have to implement them. And that has to cast some doubt on the credibility of the overall public finance forecast. That's all from me. Thanks very much.
Thanks, Ben. Good morning, everyone. So let me share my screen. Hopefully you can all see that. So I'm going to talk through the biggest changes to personal and business taxation that the Chancellor announced yesterday, starting with changes to income tax and national insurance thresholds. Now, the thresholds for income tax and employee national insurance are already being frozen for 4 years. Yesterday, that was extended for a further 2 years, along with extensions to various other freezes to thresholds. Until now, the threshold for employers' national insurance hadn't been frozen. That's now being frozen until the same point as well. And the Chancellor reduced the point at which you start paying the 45% additional rate of income tax from £150,000 to £125,140. The reason for that specific number is because once your income exceeds £100,000, your personal allowance gets withdrawn, creating an effective 60% income tax band above £100,000. £125,140 is where that tax band ends, so you'll now go straight from that into the 45% band. And that final change will increase the number of additional rate taxpayers by about £350,000. So just the increase from yesterday's announcement is more than the total number of additional rate taxpayers that there were when the additional rate was first introduced. And this just is coming on top of a long line of freezes. Now, it's now the case that essentially every significant threshold in the income tax and national insurance system is being frozen over a long time horizon. Now, that's just not a sensible way to make policy. It means that the size of the tax rise depends hugely on what inflation turns out to be. It's an accidental and arbitrary outcome of that, rather than being the result of a deliberate policy choice. So just to take an example, the original 4-year freeze to income tax thresholds had been due to raise £8 billion when it was first announced. By the summer, we thought that was on course to raise more like £30 billion, almost 4 times as much. Inflation expectations are now a bit lower, so that's now down to £24 billion, although there are now additional freezes on top. You can see it just goes up and down according to what inflation turns out to be, and clearly we can have no idea what that'll be 3 or 4 years down the line. So what do these changes mean for people's incomes? So this shows how people's net take-home pay after tax will change according to their level of earnings. And this first yellow line shows what it looked like before the autumn statement, the changes that we already knew about. If we add in the changes that were announced yesterday, you see the tax rises for pretty much all income levels have got bigger. Again, depends a lot on what inflation turns out to be, but maybe £180, £200 more in tax per year for most taxpayers, something more like £1,500 more tax per year for those above £150,000 a year. But bear in mind, that's not necessarily a bigger percentage of their income. So this long period of freezing thresholds, particularly when inflation is so high, will obviously increase the number of taxpayers and the number of people in higher tax bands. Now, this shows how the number of higher and additional rate taxpayers has changed over the years. By the end of these freezes, we reckon almost 15% of the adult population will be paying high rate tax. That's up from 8% just a couple of years ago, and under 4% in 1990 when individual taxation was first introduced. And there'll actually be 2 million people just above the £100,000 threshold and therefore facing 45% or 60% marginal rates of income tax. And more people above the £100,000 threshold than there were higher rate taxpayers in total in 1990. Turning to council tax, the Chancellor announced that councils would be allowed to increase their council tax by up to 5% a year for the next 5 years. That's up from a limit of 3% this year. The OBR reckons that by the end of the 5 years, that'll be raising almost £5 billion a year more for councils. Now, that's assuming that councils essentially take up their freedom to increase council tax rates in full. This chart shows that if they do that, rather than say increasing it by 3% a year, that would increase council tax bills by about £160 a year on average, and would leave us on course to have the highest ever real terms council tax bills. Now, actually, that might not be that surprising. We might expect council tax to rise in real terms. We might expect it to keep pace with incomes, say, or keep pace with house prices, not that incomes are rising that much at the moment. But the underlying point here, the bigger point, is that this is essentially an increase in an unreformed tax. Council tax remains regressive, distortionary, and above all, still based on hopelessly out-of-date property values. In contrast, business rates is being brought up to date from next April. It'll be based on 2021 property values rather than 2015 values. That's a very good thing. The government is devoting £1.7 billion to ensure that those whose tax bills go up as a result of having their property revalued will see the bills rise only gradually, whereas those whose bills will fall can see it fall immediately. The Chancellor also announced 2 other cuts to business rates. It wasn't just a tax-raising autumn statement yesterday. First was a 6% real-term cut to business rates across the board. So if I show you now, the tax payable as a percentage of property value, it reduces it from this light green line to the darker line. So for a typical business with a rateable value of, say, £20,000 or £30,000, that'll be worth a few £100s a year off their business rates bill. The other cut to business rates was more specific. It was a 75% reduction for retail, hospitality and leisure businesses for 1 year only. So that one will be worth more like thousands of pounds rather than hundreds of pounds for a typical qualifying business. Now, that's supposed to be for 1 year only. It's coming on the back of a history of a series of other reliefs like this, but actually it's even more generous than the 50% relief that this sector is getting at the moment, which was supposed to be a temporary thing to help with the tail end and the aftermath of the pandemic. It's quite hard to see what the for another huge, even bigger relief for retail for 1 year only. But given the history of this, it must be doubtful whether it really will be for 1 year only. And the more people believe that this is going to be permanent or keep being repeated, the less effective it'll be at supporting the sector, because the more we'll tend to see rents on these properties increase so that it benefits landlords rather than the retailers themselves. Again, the broader point with business rates here is that it looks like the government doesn't much like business rates and the effects that it has, but it doesn't quite know what to do about it. It had a fundamental review of business rates, but it didn't lead to fundamental reform. Yesterday, they confirmed they wouldn't be going ahead with a move to an online sales tax, which I think is very good that they're not doing that. But they just seem to be responding by saying, well, we'll have ad hoc reductions and adjustments to business rates here and there, whenever we think it's needed or suitable. That's not really an adequate solution. We need a better vision for what business rates should be doing. The other big announcement on business taxation was, of course, extensions to the windfall tax on the energy sector. So this shows, first of all, the standard rate of corporation tax in the UK and how it's changed over time. Profits from North Sea oil and gas have always been subject to higher tax rates than this. The energy profit levy that was announced in May said that rather than the tax rate for profits on oil and gas continuing at that level, it would go up to an effective rate of 65% for up to 3.5 years. Yesterday, the Chancellor announced that the rate would be higher and that it would last for longer. And this almost doubled the revenue that he expects to get from it. Of course, again, very uncertain, depends on what happens to oil and gas prices and therefore the profits from these companies. This is a pretty substantial, if temporary, tax increase. They're really just taking tax rates on oil and gas profits to around the levels that they've been for, well, much of the previous 40 or 50 years. The windfall tax was also extended in another way, as well as increasing it for North Sea oil and gas producers. There was a new windfall tax on low carbon electricity generators, which again the Chancellor expects to raise a fairly substantial £14 billion over the 5 years or so that it's in place. Now, the government's been thinking for a while about how exactly to do this, and this replaces an earlier plan that they had. We think this looks like quite a reasonable way to tax the windfalls that these companies are receiving if you decide you want a windfall tax on these profits. There are also a series of smaller tax reforms that I won't spend much time on. There was a common theme to them of really missed opportunities here. There was a reversal of the cut to stamp duty announced in the mini budget, which I think is a bit of a shame. Of all of the tax cuts in the mini budget, that was one that I would like to have seen kept, at least the broad brush reduction. There was the introduction of vehicle excise duty for electric vehicles. Now, the government badly needs a strategy, a plan for how it's going to tax electric vehicles in the future. Just putting vehicle excise duty on them is not a good plan for how you want to tax them in the long term. And the Chancellor slashed the allowances, the amount of dividends and capital gains that you can receive tax-free. Now, capital gains tax in particular is badly in need of reform. You can argue for or against cutting the allowances, but I think what I would say fairly safely is that it wouldn't have been near the top of my list of reforms that we need to capital gains tax. Everything from the reliefs of business asset disposal relief to allowing for inflation to the way that it operates at death would be higher priorities. So to sum up, this was a substantially, although not enormously, tax-raising autumn statement. Some of the biggest tax rises, of course, were only temporary, and there was at least one significant tax cut in amongst the general theme of tax rises. But overall, the Chancellor has broadly opted for a set of what looked like relatively easy revenue raises rather than much needed coherent reform of the system. Simply announcing freezes to thresholds in future years when you've got very little idea of how big a tax rise that'll turn out to be is not a good way to make policy. And then areas like the taxation of property, whether that's business rates, council tax, stamp duty, how we should tax electric vehicles, how we should tax capital gains, these are all areas that need serious thought and well-considered reform. Now, to be fair, the Chancellor is new in post and had only a few weeks to prepare a budget in what was almost emergency circumstances. So I think I might cut him a bit of slack on this occasion, but I would say I would hope for some more considered reform when the Chancellor has a bit longer to think about the issues and bring forward his plans. At that point, I will stop and hand over to Xiaowei.
Thanks, Stuart. Okay, so I'm going to talk about the outlook for living standards and government support for the cost of living. The outlook for living standards is frankly quite dire. The OBR forecast and that real household disposable incomes will fall by 7% over the next 2 years. Now, this chart shows the year-on-year change in real household disposable incomes over a long period of time. We see that since 2008, we've seen a number of shocks to real incomes, many more than we've seen in previous decades. But the falls in real income we're expected to see in the next 2 years are far larger still than the shocks in recent history. And indeed, they're the largest falls we've seen since record began. This comes on top of already more than a decade of lost growth since the 2008 crisis. And the OBR forecast that we won't return to pre-pandemic levels of real household incomes until after the 2027-28 financial year. Now, the blue line here plots what would have happened to real household disposable incomes had the pre-2008 trend continued. And I've shown this chart a couple of times and it gets more ridiculous each time. But according to the OBR's forecasts, by 27-28, we're going to be nearly a third poorer than we would have been had the pre-2008 trend in growth continued. The grim outlook in living standards over the next 2 years comes despite a large package of government support for the cost of living crisis. So the Chancellor's confirmed that the energy price guarantee will carry on into the next fiscal year. The typical household energy bills will be capped at £3,000 a year, which is estimated to cost 38 billion over the next fiscal year. Now, this compares to a cost of 55 billion to keep the cap at the current £2,500 level until September 2024, which is what Kwasi Kwarteng intended. So compared to a situation in which the government did nothing and there was no energy price guarantee, the median household would save £270 per year as a result of the energy price guarantee. However, even with the guarantee, most households will see a large rise in their energy bills. So the median household will see an increase in their energy bills of £900 compared to today, when there's a 2,500 cap in place and most households have access to this £400 energy rebate. And compared to the last fiscal year before the energy crisis happened, the median household will see an increase in bills of £1,800. Now, I've said that the median household will see an increase in £900 in bills compared to today. However, there's huge variation in how much energy bills will increase depending on how much energy households use. So this bar here plots the distribution in the increase in energy bills, and we see that 1 in 4 households will see an increase of less than £700, so that's the 25th percentile, whilst more than 1 in 4 households will see an increase of more than £1,200. You see this variation in the increase in energy bills right across the income distribution. So even for the very poorest households, those in the lowest decile of household incomes, 1 in 4 households will face a rise in energy bills of more than £1,150 compared to today. The Chancellor's also announced another package of one-off cost of living grants, totaling £11 billion in the next fiscal year. These grants will be targeted at specific households, so there's no universal component, and the £400 energy discount that almost all households got this year will no longer be in place next year. Households on means-tested benefits will receive £900 next year, with additional support for pensioners and those on disability benefits. Turning now to ordinary benefits, so not benefits specifically targeted at the cost of living crisis, the Chancellor is committed to uprating most main working age and disability benefits with CPI inflation. So in April next year, they'll go up by 10.1%. Now, this is a big increase, roughly keeping pace with inflation, but it won't make up for the falls in real benefits last year when the benefit operating failed to keep up with inflation. And as a result, real benefits won't return to their pre-pandemic levels until after April 2024. So I'll talk about this in more detail later. In addition, the Chancellor has announced a one-off operating of the benefit cap with CPI next year. So the benefit cap affects around 130,000 households as of May 2022. These are mostly large households and those with high housing costs, and it's been frozen in cash terms since April 2016. So the operating of the cap with inflation is obviously welcome and will come as a big relief to these households. However, it's disappointing that the Chancellor hasn't committed to operating the benefit cap in line with main working age benefits going forward, as we recommended in the Green Budget. And we see clearly that, you know, operating the cap by 10% next year is a positive change, but in a context when prices have increased by 24%, that still means a big cut in real terms since April 2016. I should note also that although most benefits have been operated with inflation, the housing element of benefits for private renters, the local housing allowance, has been frozen in cash terms since April 2020. And since April 2020, there's been a 6% increase in average private sector rents. Now, I've said that real benefit levels won't return to their pre-pandemic levels until April 2024. This is because benefits are only operated once a year with a lagged measure of inflation. So benefits are operated in April using inflation measures in the previous September. And the fact that we've had consecutive years of rising inflation since the pandemic means that benefits are lagging behind the cost of living. So this chart shows the average benefit entitlement of out-of-work claimants in real terms, excluding the housing element, which, as I said, has been frozen. And you see that because of rising inflation, the real value of benefits fell between 2019 and April 2022. The current operating is just keeping pace with inflation, so keeping pace with this lower level of benefits. And it won't be until April 2024, when inflation subsides, that real benefit levels actually catch up to their pre-pandemic levels. So the fact that real benefit levels are lagging inflation is one of the reasons that the government's introduced these one-off cost of living grants. Another reason being that lower income households spend more of their money on energy and food, which have gone up steeply in prices. And we see here that on average, abstracting from differences in inflation faced by households, so assuming all households face the same levels of inflation, we see that on average, these cost of living grants have roughly kept real benefits at around pre-pandemic levels. However, this is just the picture on average, and really flat rate grants are not a good substitute for just operating benefits with current inflation. That's because there's huge variation in how much benefits people get. So in this chart, I'm plotting the number of households receiving different levels of universal credit per month. And you see that there's huge variation. So £900 a year in cost of living grants will be a huge increase for those receiving very low levels of universal credit. So for example, for the 160,000 households receiving less than £100 a month, but it won't go very far at all for those receiving very high levels of benefits. Another issue with a flat rate grant is that it creates a cliff edge. So someone at the very end of the UC taper will be entitled to the full £900, whereas someone earning just above that will receive nothing at all. So bringing together the cost of living support, the benefit measures we've seen, as well as the tax measures that Stuart talked about. Here I'm showing the effect of these policies on households across the income distribution. And we see that before the autumn statement yesterday, there was already a progressive set of policies planned for the next fiscal year compared to the tax and benefit system in November 2021. So at the bottom of the distribution, the changes to the universal credit taper, which make universal credit more generous for in-work households, as well as some indirect tax measures, will boost incomes at the bottom of the distribution, whilst freezes to income tax thresholds would reduce incomes for higher income households. Now, the measures announced yesterday reinforce this progressive pattern, with the cost of living support targeted at low-income households, whilst the rise in employment and the lowering of the additional rate threshold mostly hitting high-income households. The energy price guarantee, the savings from the energy price guarantee are broadly evenly distributed across the distribution, and overall households will gain in cash terms on average, with lower-income households gaining more in cash terms. I want to be very clear that I'm just talking about cash changes as a result of these policies. I'm absolutely not saying that lower income households are going to be better off next year, given the rising price levels that they'll see. So looking into the longer term, to 2027, 28, after the temporary support expires and after the cost of living crisis subsides, we see that policies will result in tax rises across most of the distribution, with the autumn statement reinforcing previous plans. Bigger falls in incomes largely due to the decision to keep tax thresholds frozen up until 2027. So overall, you see that the lowest income households will see increases in their income as a result of tax and benefit changes since November 2021. And most of the distribution will see decreases in their income, with the biggest falls coming at the top of the distribution. So to summarize, we're heading for another lost decade of income growth, with the next 2 years being the biggest falls in real household income on record. And this is despite another big package of support for households in response to the rising cost of living crisis. Despite the support, the median household will still face a rise of £900 in energy bills compared to today, and £1,800 compared to last year. The cost of living support this time around will be targeted at specific groups. There'll be no universal element, and as such, we can expect some middle income households to really suffer next year. Ordinary benefits, so not benefits related to the cost of living crisis, will be uprated with inflation next year. However, they'll still lag pre-pandemic values in real terms until April 2024. Now, this is part of the reason for the cost of living grants that we're seeing, but as I said, these flat rate grants are really not a good substitute for simply uprating benefits with current levels of inflation. Overall, taking the tax and benefit measures as a whole, we see that these are a progressive set of policies. In the next fiscal year, we'll see the poorest households gaining the most in cash terms, whilst the richest households will lose out. And in the long run, to 2027, 28, we'll see tax rises across most of the income distribution, with the largest rises taking place at the top of the distribution. Okay, thanks.
Thank you very much indeed to Carl, to Ben, to Stuart, and to Xiaowei. We've run quite a long way in terms of time with all of that. As you can see, there was an awful lot of analysis there, an awful lot to see. So we will get through what questions we can. There are quite a number of questions here about growth, and in particular, Anna Isaac of The Guardian summarises what quite a number of people have asked, which is, could Paul please spell out what he considers the series of economic own goals in recent years? Well, I'll offer a few. My colleagues might want to come in with some more, but if we go back to 2010, I think let's start with slashing investment spending would be one. Remember, that was something that was announced under the last Labour government and continued by George Osborne. Reducing investment spending, not a good way to get growth. Cutting spending on education, particularly huge cuts to vocational further education, but also to schools over that period. And note, while school spending is going up over the next period, spending on further education, sixth form vocational education, didn't get a mention yesterday. That will be number 2. Very clearly, Brexit was an economic own goal. There may be other reasons for Brexit, but economically speaking, that has been very bad news indeed, and continues to be bad news, particularly the way that we've done it, the hard type of Brexit that we've had, distancing ourselves from the single market. Obviously, the mini budget of a couple of months ago didn't help, shall we say? In fact, it was that was another large own goal. Carl, Ben, particular, Stuart, do you have any other big own goals that you might want to suggest? If not, don't worry. That might be enough own goals. Doesn't sound like they've got any other own goals, but I'm sure we could think of a few more if we had the time. There's some sort of more positive questions about whether the Chancellor could have done more to improve the growth potential. I mean, as Stuart said, a little sympathy given that he's only been in post for a couple of weeks. But clearly there are numerous things that one could do to improve growth. Again, I've already mentioned the spending on vocational further education and so on. Let's hope that we do get a return to looking again at planning policy. There's much that could and perhaps should be done within the tax system. Stuart referred to the general lack of strategy there. There remains a lack of strategy in the corporation tax system. Rishi Sunak promised a review in the light of the very big increase in the main rate coming in next year. All we've seen so far in the mini budget is a relatively minor increase in investment allowances. Again, any of my colleagues like to offer their two penneth on what he should actually have done if he really wanted to get a bit more growth? Carl, perhaps you'd like to start.
I'm afraid I had to reboot my computer, so I'm only now back. I missed the question.
Growth. What would you do to get some growth?
Well, clearly what we want is sustainable growth. So this is not about trying to just put money into the economy in the short run. It has to be about a set of policies that will increase trend growth over the longer term. So you want to look at serious tax reform, not just tinkering with some tax rates. You want to look at government investment policy. You want to look at education policy. You want to look at immigration policy. You want to look at planning law. Whole set of things I think we know that can be good for growth. Doing them isn't easy, though. There's reasons why previous governments have shied away from them. And even if you do them and get them right, you've got to be prepared to understand that the returns from that will be in the long run. So if you get your education policy right, it's going to be decades before you fully reap all the rewards from that. That's not to say you shouldn't be doing them, but there's no quick fixes here.
Yes, I think it was Ed Conway who wrote only slightly tongue-in-cheek in one of the newspapers recently that if you really want growth, you want to concrete over the countryside and open up the borders to completely free immigration. The point being that there are trade-offs here. My view is that on the whole, we've been on the wrong end of that trade-off. In other words, we've been in favour of things other than growth too much, and not being willing to take some of the costs of growth, like building houses in some people's backyards, building roads close to where some people live, being part of the single market and accepting some of the constraints of that, and so on. Ben, extra cash for the NHS, does it cover cost pressures?
Before the NHS, I've just thought of a couple of own goals if you want me to add those.
Oh, go on, let's have some more own goals.
Sure. So, I mean, two quick ones. One is just failing to deal with some of these sort of fiscal problems we've been able to see a mile off, slowly trundling down the track, and yet we've done nothing about, knowing that we're going to phase out petrol and diesel cars, but doing nothing about actually implementing any sort of roadmap towards road pricing and dealing with the fact that fuel duty is going to disappear. Not doing things like thinking about the tax treatment of defined benefit pensions, defined contribution pensions before and their inheritances ahead of time. So those sorts of short-sighted measures. And then on one of the big problems we're facing, as Carl talked about, is this big spike in debt interest spending. Part of that is because as bankers the Bank of England increases its base rate, that leads to much higher spending on interest payments on reserves held at the Bank of England. Falls out from quantitative easing. And Paul Tucker wrote in our recent Green Budget about how this was foreseeable ahead of time, and had we taken, action a few years ago, we could have headed off that problem and we might not be facing as big an increase in debt interest. On the NHS, there's lots of moving parts and it's hard to reach a sort of firm conclusion. So the NHS had said originally they reckoned that they were about 7 billion short because of cost pressures and pay pressures. Yesterday, they got about 3.3 billion. The NHS have since said that 3.3 billion plus about $1 billion of efficiency savings means that they're more or less compensated. It's worth saying that the extra money comes with additional demands on the NHS in terms of what they're expected to deliver. So I think they look to us like they're maybe ever so slightly worse off in real terms, but they're now saying they can make a bigger efficiency savings, and maybe it sort of adds up. They're certainly doing better than other public services that haven't had any extra cash provided. I think there's a question there about pay and how much extra pay might eat into that money available. As a sort of rule of thumb, this isn't precise, but every extra percent on the NHS pay bill costs maybe 800 million to about maybe to $1 billion. And so if next year, rather than giving 3% pay awards, they give 5% pay awards, you might expect about half of that extra cash to get eaten up. But that's that's back of the envelope. It's not based on any sort of detailed bottom-up analysis.
Brilliant, thank you. Question from Tom Rees of The Telegraph here. Probably some combination of Carl and Xiaowei, I think this is for. Almost half the projected increase in welfare is driven by disability and other benefits linked to long-term sickness. Is this worrying? Well, I think the answer to that is yes. How does the shrinking workforce impact the economy? There's a question there about investment as well, which seems to be rather separate. But the increase in welfare driven by long-term sickness and its impact on the economy. Xiaowei or Carl, would you like to have a shot at that?
I'm happy to have a go. I mean, yes, it's clearly of potential concern. I think really we need to work out the extent to which it's the benefit system doing a better job of recognizing the extent to which people have got health-related problems, in which case at least part of the story would be a good news story. But you then still want to tackle how do we get people in a better position? How do we help them manage those health conditions and have better options in their lives? And if it's not that, then clearly we want to be thinking about how can we design the benefit system to make sure the money's really going to those who need it. So it's certainly worrying. So yes, I mean, the shrinking workforce, with colleagues have put some work out recently looking at people in the years approaching state pension age, where we've seen a big drop in the proportion who are in work or looking for work, a big increase in the proportion who are economically inactive. We don't think that the increase in the numbers of people moving out of work is because of them being in worse health. We think the increase in poor health is actually occurring amongst people who've been out of the labour market for some time. So there's actually two problems, if you like. There's one is, why are people who've been out of the labour market for a while seem to be getting sicker than they used to? And that's something we certainly need to focus on. And there's a second issue, which is about why are increasing numbers of older people post-pandemic choosing to leave the labour market? And is it a choice that they're happy with, that's a good choice for them, in which case maybe it's fine. Of course, it'll have consequences for the labour market and for the public finances. Or is it potentially something that they will subsequently regret if, for example, they're running down their pension fund and they may find in a few years' time their pension pots aren't as healthy as they'd hoped for? So again, certainly something that's worthy of more study.
I think it's worth also adding... Sorry, go ahead, Xiaowei.
Okay, I just wanted to comment on this point on rising disability benefits as well. I don't think it is just a matter of the benefit system supporting more people, because we do also see a rising share of people reporting long-term health problems. Now, as Carl said, the extent to which that's driving the rise in inactivity we've seen is unclear. It does seem like lots of people are moving into retirement. Although that said, we do know that people who report long-term sickness are less likely to re-enter the labour market. And we have also seen a decrease in flows out of inactivity that may be due to rising sickness among this already inactive population. So I think that's something we'd need to dig into a little bit more. In terms of, the falling labour supply in general, of course, that's going to be bad for the economy and that's going to constrain growth. And actually, relative to the March forecasts, the OBR actually downrated growth due to rising inactivity compared to what was expected in March. However, that was exactly offset by an increase in immigration from outside the EU that they weren't expecting in March. So overall, no effect on labour supply, but the rising inactivity rates are obviously worrying for growth. I think it's particularly worrying in the context of growth in the 2010s. So the OBR had a really interesting chart in the EFO this year that showed that in the period between 2010 and 2019, growth was mainly driven by increasing hours worked. So it's driven by increase in the labour supply, increased hours work of people, in work, as well as increased immigration. With very little growth being driven by capital investment or productivity growth. If you contrast that with growth in the period between the late 90s and before the financial crash, a lot of the growth then was driven by productivity growth as well as capital investment. So that's a very different picture. And now in the context of, at least not rising immigration and potentially falling labour supply, we're really going to have to look at how we can get productivity growing again.
Really important points there from Xiao Wei. It's also worth reflecting on the fact that a lot of people on disability and incapacity benefits are now relatively young. This is something which is particularly affecting less well-educated young people, particularly lots of mental health problems in that group. Big increases in recent years, and particularly in spending on personal independence payment. This is something the government really does need to get to the bottom of and get a grip on. There's a question here from Joel Massey. To what extent is the fiscal tightening due to the mini budget and Brexit? He says the OBR chair downplayed those. It is true that that gilt rates have sort of gone back largely following the mini budget, but this is one of the other economic own goals, actually, which one of my colleagues has just emailed me to remind me about, which is that the general economic and political instability and uncertainty that we've had over the last several years, which are associated with Brexit and also with that mini budget, have definitely been a constraint on growth. To have 3 prime ministers and 4 chancellors in a few months, and to be reversing policy here, there and everywhere, to be uncertain about your trading relationship with the rest of Europe, have corporation tax going up, down and round and round and round. All of that is bad for growth. And that, in some sense, you could say the mini budget was a symptom of that. You could also say it was a cause of that. Clearly, the economy, as the OBR itself has said, is significantly smaller as a result of Brexit, and that clearly makes the fiscal situation more difficult than it otherwise would have been. We've only got a couple of minutes left. Would any of my colleagues like to pick any particular one of the very many questions that are still there that they're really keen to answer? I'll give you 10 seconds to answer that, or I will ask one myself.
There's a question about schools funding, which is quite easy to answer.
That's a good reason for choosing.
Yeah, which is it going in real terms? The answer is yes. So our colleague Luke Savietis has shown that if you just use a GDP deflator for pupil funding by 24-25 is set to be above its 2010 level in real terms in England. If you use Luke's school-specific cost index, which allows for things like better accounts for things like pay awards, it's still set to be back at effectively 100% of its 2010 level by 2025. So that's 15 years of lost schools funding growth, if you like, but those cuts will be undone and it will be rising in real terms over the next few years.
Brilliant.
There's quite a few questions about the kind of potential coming spending cuts and how they compare to the austerity of the 2010s, where I think, I'm not going to give a quantitative answer on that. Essentially, the spending cuts through the 2010s were really very, very big. They were much bigger than what's now being expected over the next few years. But I think it's also a very different context. In 2010, 2011, Mr. Osborne was trying to do big spending cuts after a period where there'd been big spending increases in lots of areas of government. If we try and do any spending cuts now, it'll be coming off the back of several years of deep spending cuts in lots of areas, and also public services which are having to deal with things like extra responsibilities because of Brexit, extra challenges because of the pandemic. So a much harder era to do, a much harder time to be doing cuts than it was, say, in 2011.
Right, we should stop there. Thank you so much, everyone. I should say, members of the press who have not had their questions answered or have further questions, do feel free to get in touch with me or through with my colleagues or through the press office. I don't mean this meanly. I sincerely hope that we don't see you again at an event like this until after a budget in March. I'll be happy if we have another fiscal event between now and then. But for now, thank you very much for coming and watching our analysis at this event. Particular thanks to all of my colleagues who have had very little sleep over the last 24 hours for another fantastic set of presentations. Everything that you've just seen is on our website as of now. Thank you very much. Our website as of now. Thank you very much.